Why don't you call the meeting to order and we could start?
Excellent. I'm going to ask for about 30 seconds because I have to just pull something up here. Then we will.
There's Barry.
Well, you know what? I think I can pull this off here. So I'm going to call the investment committee meeting to order. And Ellen, I'll ask if you can please take the roll call for the meeting.
Certainly. Trustee Bartholomew.
Present.
Trustee McMahon.
Present.
Trustee Martin.
Present.
And Trustee Riley.
Here.
We are all set.
Okay, so we're going to start the meeting this morning to discuss the FY 2024 endowment spending rate. And I will transfer this topic over to Tracy Elliott for her to review and answer any questions in regards to the tab item 1.
Thank you, Trustee Martin. The first item is an action item, and it is for the fiscal year 24 endowment spending rate for the campuses. We're asking for your approval of a 4.5% rate. This rate is the same as the current fiscal year 23 rate, and we've reviewed this with the chief business officers, and they're supportive. It would generate about 6.6 million of budgeted spending. That includes just over 5 million for endowed purposes like scholarships and professorships. It would also generate about 1.3 million to support efforts related like fundraising and managing endowment activity. Only the University of Maine, Southern Maine, the law school, and the governance and university services charges this management fee, with the vast majority, 1.1 of the 1.3 million going to the University of Maine, of course, based on their large endowment size. And that is a fee that was approved a long time ago by the investment committee. NEPC does annually review the portfolio return expectations. They did that last in June. The endowment is invested in the managed investment pool. Using the 30-year expected market returns, we could expect a return of between 7 and 8.1 with obvious significant volatility and an additional 0.5% for active management. So that 4.5 requested endowment disbursement should be well able to accomplish that with the expected return. On a final note, I would also mention we do have some underwater endowments this year, and that is when our endowments drop below that initial investment value of the corpus from the donation and bequests. There were 9 funds that had initial values of about $2 million that went underwater by a total of $265,000 at the June fiscal year end, June this past year. No endowment funds were underwater last year. Our policy is to not distribute for fiscal 24 until those endowments regain value to come above corpus. I'd also mention that we have foundation funds and other scholarship monies for which we're the fiduciary and invest in our managed investment pool. And there were 21 of those funds that had initial value of just over $7 million that were underwater by just 250,000. So it's the same policy for them. And last year they just had 2 endowments that were only underwater by $500. Happy to take any questions you may have before the vote.
But Tracy, what's the date that the 4.5% is calculated on?
It is June, and we use a 12 quarter rolling.
12 quarter rolling average as of June 23 for the fiscal year 24.
Correct.
Okay.
Yeah.
So it's June 30th.
Yes, it is. Or whatever the last business day of the year is. Yeah. Yeah. Yes.
Tracy, this spending rate, is it in line with what other academic institutions are doing in this kind of dynamic environment?
Yes, we take a look at the TIA study that's done annually. We look at that, we talk with our peers, and it is in line with what others are doing.
Thank you.
Any other questions? Thank you, Tracy. Hearing none, I'll read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, approves an endowment spending rate of 4.5% for FY 2024. Any questions or discussions? Can I have a motion?
So moved.
So moved by Trustee McMahon.
Second,
Second by Trustee Bartholomew. And Ellen, I will
Certainly.
transfer to you
Trust-
for a roll call.
Trustee Bartholomew,
yes.
trustee McMahon,
Yes.
trustee Martin,
Yes.
trustee Riley.
Yes.
The motion is carried.
Great, thank you, Ellen. And has Barry joined the call?
Yes, I'm on.
Hey, good morning, Barry. How are you?
Good morning.
I will transfer the meeting to you to discuss a defined contribution plan. And actually, I believe you have tabs 2 through 5.
Yep.
And in that we have 2 action items. So
Yep.
You got a big job this morning.
I do.
Thank
I'm going to share my screen here. Can you all see that okay?
Yes.
Let me just flip through to as you all know, one of the things that we always want to do is make sure the committee is no more than 90 days out of any things that's happening from a kind of a topical market perspective. And so we have a couple items we wanted to share with you this morning. You know, we always want to point out we have kind of fiduciary light training each quarter. And this particular quarter, we wanted to point out common retirement plan failures. You have a really good partner in TIAA. They make sure you're up to speed on these. But when failures do happen, these are some of the top failures. You know, the number one is like if they don't update the plan documents with regard to changes in the law, like think Secures Act, think CARES Act in the pandemic period. Compensation is also an issue with respect to defining compensation. But again, this is just an area we don't necessarily see any particular issues with the University of Maine plan, but this is always important to point out to make sure that we have the documents and the documents are aligned with the way you operate the plan. The other thing that's happening too is it's a thing called auto portability. This is simply in, I think, proposal stage at this point. But if you think about somebody that joins the University of Maine system, if you'll notice here, most employees have 9.9 jobs. I'm not sure why they didn't round it to 10, but they have 9.9 jobs during their career. And so if you think about somebody starting out, they accumulate $3,000-4,000 in their retirement plan, they move to another institution. Unless they act, the money either sits there or we pay out in the form of small account balance payout. So there's this thing going on about is there a way that we could automatically port over to new employer's plan any remaining balances from the prior plan? And it's only as good as the organizations that subscribe to this. I think so far Fidelity, Vanguard, and I think Alight have signed up for this with a firm called Retirement Clearinghouse. But it's a mechanism for your benefit, like the smaller account balances are a drain on the overall efficiency of the plan. So getting those account balances out is a good thing. But also if they join the plan and they have prior assets at prior institutions is a good thing because they will accumulate those assets and automatically roll that over. So more to follow on this one, but this is kind of in the early stages, but we thought we'd at least share that with the group this morning. The other area that I think we're going to talk a lot more about in 2023 is fresh off the press. The Department of Labor did come out in December with some new guidelines for environmental social governance types of investments. And they've had it in kind of three categories: an integration fund where they use some ESG factors in considering with respect to their investments, a focus fund where it's a major factor in how they might want to manage that particular vehicle, or an impact fund where they have a particular fund that seeks to achieve a particular ESG objective. So, this is kind of the former administration, the Trump administration, was a lot more restrictive. Clearly, the Biden administration wants to be less restrictive and more inclusive in terms of ESG. So we would assume that in 2023, as this kind of works its way through our internal processes, we'll come back to you with some thoughts about maybe how we might want to employ this. But as you see today, we have a couple funds that we have ESG factors, but also with a self-directed brokerage window. If somebody wants to have a particular fund and a particular strategy for a particular view, that so far we've allowed them through the brokerage window to do so. Again, what we think that's going to be more of a topic of conversation in 2023 for sure. So let's change gears to the market. Again, there was another challenging quarter. If you think about kind of where we were in 2022, we've had this really pervasive interest rate environment, higher interest rates. The Fed has said price stability is going to be their number one concern. And so consequently, we've had an historic raise in rates over a very, very short period of time. I don't know if you saw the markets yesterday, but they key on every single word of Chairman Powell. And I think Chairman Powell yesterday saying that he might want to moderate the pace at which they raise rates. So the market took that and ran with it through yesterday. And so we did have some pretty strong performance through yesterday. It'll be interesting to see if that kind of carries forward over the next several weeks. And we've seen in the past initial jubilation and overall then a kind of the slow trough down to kind of where we are today. So we do believe there's still continuing headwinds out there in terms of volatility, in terms of price stability, and the Fed has said we're going to continue to do that. So it was good to see the markets react favorably, but at the same time, we'll see if it's sustainable or not. You don't have this in front of you, but I looked at performance through yesterday on some major indices. So as of yesterday, the S&P 500 is now down a little over 13%. So we've had a little bit of a pivot since the end of September. The international markets, as prescribed by EFA, are down about 14.5%. Emerging markets down about 19%. And then the aggregate bond index down about a little over 12.5%. So we've had a little bit of a resurgence since the end of September. So if you think about what we're thinking what drives the market, if we'll start on the right hand side with tailwinds, we are starting to see some breathing room of supply chains, although if you've read in the press over the last couple of days and kind of the protests in China with their zero COVID policy, that's something we're going to watch out for pretty closely, because that could have an impact on supply chains going forward. But heretofore we've seen at least some relief in the supply chain issue that we've had pervasive throughout the in essence really the pandemic period and post-pandemic period. The interesting thing also is a strong labor market. There's still over 10 million jobs that are unfulfilled, and that's been kind of a bright light in an otherwise negative, volatile market. So it's been pretty resilient at this point. And then low expectations. If you think about it, an investor has emotions, and when there are periods where the expectations are really low, there could be opportunities for longer term that would be a good entry point for investors. And we think low expectations are pervasive currently in the marketplace. On the headwind side, again, Fed combating inflation, they'll continue to do that. Although we had, the inflation numbers a couple of weeks ago were about 7.7% for the prior month. I think the Fed is really looking for an accelerated relief on inflation. And so if that does happen, there could be a little bit of an initial bounce back, but we do think there's still some challenges that remain in 2023. Leading indicators are lagging. You've seen kind of more recent mortgage rates. They're 6-7% now for 30-year fixed mortgages. That's going to lessen the ability for people to buy new homes. That's going to slow down the housing market. So that's going to be something we're going to watch out for. And I think at the time we wrote this, midterms were on the horizon. It's going to be really interesting to see how the Republicans, I guess they have a slight majority in the House based on the new Congress, but how they will transact business in such a slight majority. It'll be really interesting to see over the next several months exactly how that's going to shape out. So that remains to be seen. But the markets like gridlock, the markets like where they don't have a lot of legislation. So the markets have it's more known, but it'll be interesting to see nonetheless how the Republicans handle the reins at this point. We have a couple other charts in here. I know we have a couple other things we want to really dive into, but this I thought was an interesting chart. If you look at prior times where the Fed has raised rates, it was much more gradual. You've heard a lot about that over this past year, but you can see in 2022, the speed at which they have raised rates has been historic, as opposed to 1994, 1983, 2004, et cetera, where it was a much more gradual increase of rates. So that's really created a havoc, especially in the fixed income market. The one thing I will leave you with on the market, and I'll certainly open it up for any questions or comments, is if you look at the S&P 500 as kind of a bellwether for the overall market, through the end of September, the S&P 500 was down about 24%, and nobody likes negative performance for sure. But if you look at where we've been, even with that negative 23% negative performance, the average return for the last 3 years in the S&P 500 has been 8.16%. The last 5 years has been over 9%. The last 10 years has been 11.7%. So while we don't like negative performance, part of the natural business cycle, we've had a really good run since kind of the post-recessionary period of 2008, 2009. So I think most people, if you look at it for the long term, if you had said, we're going to earn 11.7% for the next 10 years, 10 years ago, I think you would have said, I'll take that. So again, not recognizing the current market, but also recognizing kind of where we've been. Any questions or comments on the market? So let's go to the review itself. I wanted to stop on this page. So, like most other plans in a participant-directed environment with a negative volatile period, we've had certainly some retraction of the overall portfolio. As of the end of September, we had assets roughly about 1.65 billion. I think at one point, we were up close to 2 billion, if not surpassing 2 billion. So we've certainly had a retraction since that point in time. But overall, the portfolios have really weathered the storm as well as could be expected. We have two funds we want to talk about today, which are, if you go down, it's the American Century Emerging Markets Fund at about 20 million. That represents about 1.25% of the assets. And then the Virtus Ceradex Midcap Value Fund, which we've talked about in the past, at a little less than 20 million at 1.18% of the assets. So all the other portfolios are in line. We don't have any particular concerns on them, but those two funds we want to dive into a little bit further. The other thing I would point out is TI Traditional. TI has raised their new money yield or new money rate. I think it was 5.75% as of the end of September. I think more recently they raised it to perhaps even a 6% or greater. So for those participants, you have over $500 million in TI Traditional. Those participants have weathered the storm really well in the sense that they've received positive performance during that period of time. That's important to point out. And TI Real Estate is also investing in hard real estate, and they've also had positive performance through the end of September. So there's two vehicles that have certainly weathered the storm, perhaps on an absolute basis versus some of those on a relative basis. Well, I'm going to go to the dashboard, which is found on page 53. And if you'll notice, again, the only two funds that are of concern to us in this page it's Virtus Ceradex Midcap Value scoring a 78. You can see funds are scoring a 100. In order for a fund to score a 100, they're in the top quartile on every period measured. You have funds that are scoring a 99, et cetera. So we certainly have been able to weather the storm on a relative basis, probably as well as any organization out there. And you can see again a foreign large blend, 94, 94, 100, American Century Emerging Markets that we're going to talk about at a 59. Vanguard Target Retirement Funds, again, this is a strategy that is fulfilled with index offerings, and they are scoring a 92. The thing about Vanguard is a couple things. Vanguard, one of the building blocks is they invest in short-term tips, and short-term tips actually have done quite well during this volatile period. So that's been a little bit of a tailwind for the Vanguard Target Retirement Series. They also employ a more of a global asset allocation strategy. So they have a tendency to have more international equities. It's probably hurt this portfolio through the end of September, although more recently the international markets have really come back as well. So it could be accretive by the end of the year. But those are really the two areas that they divert from some of the other target date funds out there, but nonetheless, really, really strong performance on a relative basis. And again, index strategies, as you all know, as long as we have low tracking error, meaning they're replicating the index, as well as low fees, we're going to pass policy guidelines, and Vanguard is obviously known for low tracking error and low fees. And the two funds are a little more distinct. Crest Stock, Crest Stock, there isn't necessarily a universe of funds that are similar to Crest Stock, so we use a different kind of metric to evaluate them. But overall, Crest Stock is doing well as TI Real Estate that I just mentioned. Any questions thus far before we move on to the two funds in question? Now I'm just going to go. I'm going to go right to. Oh, before I go on, this was the fiduciary training. We want to go through the funds first and then go back to the fiduciary training.
Sure.
Okay. Yeah. I mean, just because if there's any questions on that one, I just don't want to lose sight of that one. So just to kind of set the stage here, as you recall, we had another, emerging markets fund a number of years ago. We made the decision in probably 2020 or so to replace that particular fund with the American Century Emerging Markets Fund. This particular manager is a more growth-oriented manager. At the time, they had a little more exposure to Russia. And if you think about kind of how the market has pivoted since this point in time, obviously with the war in Ukraine, Russian assets virtually were overnight like left worthless, as well as their growth mandate has really been a pretty significant headwind for the American Century Emerging Markets Fund, as evidenced by the fact it's now scoring a 59 in our scoring system. And so we have kind of two paths that we want to talk to the committee about this morning. The first is, if you noticed before, we have a little more than 1% of the assets in emerging markets fund. So if you think about the overall portfolio, this is a really small portion of the portfolio. And so one path could be is, because it's such a small portion, let's give the manager the ability to opportunistically go into emerging markets as they see opportunities in that particular space. That's evidenced by the American Century, or excuse me, the American Funds Euro-Pacific Growth Fund. That particular fund is already in the portfolio today, but they have the ability to go opportunistically into emerging markets. And I think roughly they have about 20 to 25% of their portfolio in emerging markets today. The other path could be simply to replace the emerging markets fund with another emerging markets fund. If we were to do that, Dry House would be our top name. It's slightly more expensive than the Euro-Pacific Growth Fund, but we wanted to at least have some discussion before we kind of put a motion forward in terms of what you think the best approach would be. Our opinion is that we should replace the American Century Emerging Markets Fund simply with the Euro-Pacific Growth Fund and have the manager have the discretion to get in and out of emerging markets if they see opportunities. So I wanted to kind of set the stage, and if there's any particular opinions, strong opinions, one way or the other of a particular approach, but that's our recommendation ultimately, is to replace the American Century Emerging Markets Fund and really just replace it with the American Funds Euro-Pacific Growth Fund, and we just eliminate Emerging Markets Fund altogether. And knowing that if somebody really liked emerging markets, they could go to the brokerage window to do so. So I'll open it up for questions. Yes, Sven.
Thanks, Mike. Quick question for you. If we increase our exposure to American Euro-Pacific, what does that do for our total exposure? Does it increase it 2% or is it 10%? Just give us a line of sight on that.
Well, American Funds Euro-Pacific Growth Fund has about $14 million in it today, so that's about 1% as well, and so it perhaps double the exposure from 1% to 2%.
Okay, and that's in line with what our expectations are.
Yeah, and is there and you think about a foreign large blend, quite frankly, you have a less exposure than most of our other clients in terms of participant directed assets in foreign.
Thank you.
Can I ask the Russia question? This new fund would be, there's obviously concern about Russian investments. The federal government has been pretty aggressive about that. Where's our exposure in this new fund to Russian investment?
Very little exposure. I mean, the Euro-Pacific Growth Fund has very little Asia emerging markets exposure. So if it is, it's negligible.
Thanks.
Jim?
Yeah, just we are pleased with the Euro-Pacific Growth Fund and have been using it in portfolios for a while. we do like having a pure play EM fund for the clients that we manage it in. So that's just weighing in on that one little topic there.
And
Obviously, as you mentioned, though, we can use the brokerage window to get at that as well. So
yeah, and I just wanted to add for those who might not be aware, Jim, and when you say your clients, those include a lot of the university clients, correct? I don't know what percent, but I mean, so you're saying.
right, it's not a significant enough percent to make me want you to weigh
decision,
things
right.
heavily in my direction, but maybe a little over 100 million of it. So.
Thank you.
So do you all feel like there's a compelling reason why we ought to consider a dedicated emerging markets fund versus just having the manager opportunistically go into emerging markets as they see opportunities in the overall landscape? I did look at performance through yesterday. You don't have this here, but the Euro-Pacific Growth Fund, obviously this is a little bit different because they have more developed market exposure as well. But if you look at the overall performance on a 1-year basis, they're down 18.25. Dry House, which would be our number 2 opportunity, is down 18.5. So that slightly better performance on Europac. The 3-year performance 2.44 versus 2.64 on Dry House, so slightly better performance on a 3-year basis through yesterday. And then on a 5-year basis, Euro-Pacific Growth Fund is 2.47 and Dry House is 2.05. So slightly better performance on a 5-year basis. But that really has more to do with the overall market than it does necessarily their management style. So again, all things being equal, our recommendation is just eliminate this asset class altogether and merge it with the Euro-Pacific Growth Fund.
Barry, how much of this change in value is due to the strengthening of the US dollar? So is there some temporary phenomenon in there that's hiding some of the longer term results?
You know, there's certainly a factor in that. Yeah, I would say, it's certainly the more short-term strength of the US dollar has certainly impacted more shorter-term performance, but that tends to kind of carry itself, kind of diminish it somewhat, and when we start looking at 3-5-year performance overall. But I mean, it certainly had some impact short-term. And it's certainly been a headwind, certainly for emerging markets in particular.
So what's the general feel? Do we want to go with a fund that can go in and out of emerging markets, or have a separate play, or we'd have a dedicated emerging markets fund? So I'm hearing both sides here.
Yeah.
It sounds like, correct me if I'm wrong, Barry, but it sounds like the Euro-Pacific will go in and out as they see fit.
Yes, yeah. And they typically have about 20%. So overall, if we look at their history, they have significant exposure from its history. So they're going to have emerging markets exposure, but they can, based on markets, dial that up or dial it down.
And maybe one more question too is, do we have other managers that have this flexibility to go in and out of different investments?
Yeah, we do on the fixed income space. If you think about the PGIM Total Return Fund, that's an intermediate core plus bond fund. So they have the ability to go into high yield bonds. They have the ability to go to international bonds as they see fit. So there is some precedent. We have other managers that have the goalposts are a little bit wider. And again, we would probably have a different opinion if the exposure to emerging markets was 3, 4, 5% of the overall portfolio, because it only has 1.25%. Is it really worth chasing performance? We had another fund, we replaced it with American Century, and that's fallen on tough times. And so because of that little exposure, do we really want to chase performance?
Any other questions or concerns?
If I look at the slide, I see prospectus net expense ratio, and I see that Euro-Pacific growth is significantly less than the others.
Yeah.
Are there some discounts on the others, or are those an accurate reflection of what we're paying for an expense ratio?
They are accurate reflection. I think the thing that's a little bit unique, Euro-Pacific Growth Fund, if you look at the overall assets, 135 billion in this strategy. So they have the ability, obviously, to leverage the overall assets to lower the expense, whereas the Dry House Fund has a little bit over $2 billion in this strategy. It's really a function of the size of the portfolio. And also emerging markets in general are a little bit more expensive to operate in. They have the analyst team, the breadth and depth of their analyst team needs to be a little deeper. They have country risk, currency risk, et cetera. So it's a little bit more expensive, generally speaking, to invest in emerging market. But Euro-Pacific does that in a really cost-effective manner.
Barry, is it fair to say that you feel comfortable with Euro-Pacific in their picks to be in and out of emerging markets?
Yep.
In the past, have they done a pretty good job with that?
Yes. Yeah, they've been really a top performing fund for long periods of time, and they use it a combination of developed and emerging.
So it would be safe to say that we have a pretty good team there as far as
very deep. And
knowledgeable team.
they employ, like, it's portfolio counselors. So there's like 8 portfolio counselors that have sleeves of the portfolio that roll up into this particular strategy. So they have a really deep bench.
Okay.
And that's, again, it goes without saying, it's already an existing fund in the University of Maine plan. So it's already been in your plan for a number of years.
Makes sense.
Any other questions, comments, concerns? Ellen, I do have a quick question for you. Should we proceed on to item number 5, or should we go back to 3 on the action? Did we talk about, we didn't talk about the fiduciary training, right? We're going right through the funds as.
Yeah.
And that's fine. But before we go off of tab 4, we probably should resolve the motion.
Okay.
Well, I guess my only comment would be is, because if we do have a motion to approve this change, it really does tie into, because we're making a change, we want to look at Veritas Ceradex as well at the same time. So that Kelly, to kind of nod to you, we can go either way.
Okay. Are you guys comfortable with just going through both of them and then coming back and doing a vote? And then we'll go back to tab 3. Is that okay?
Yep.
All right. Go ahead and proceed.
Okay. So the next item is the Veritas Ceradex Midcap Value Fund. We've talked about this particular fund on and off through the last several years. This fund was perhaps even failing policy guidelines for a very short period of time, but growth as growth took hold in 2018, 2019, 2020, et cetera, this particular manager is a little more growthy than most other mid-cap value funds, and they really did well during this particular period. But we come to 2022, and this particular manager has really started to falter. They're in the 98th percentile now on a year-to-date basis, which is really filtered through all the longer-term performance. And so if we were to make a fund change in the Euro-Pacific Growth Fund, we're like, well, if we're going to make a fund change, it's probably a good time to consider a fund change to this one as well. We would anticipate, all things being equal, this fund will still probably score in our scoring system probably in the 70s, low 70s at the end of the year, all things being equal. But we think there's probably just some better options out there. And so we wanted to have for consideration, looking at two different funds out here, the Victory Sycamore Established Value Fund, as well as the MFS Midcap Value Fund. Ultimately, our recommendation would be the Victory Sycamore Established Value Fund. I did look at performance through yesterday, and the Victory Sycamore Fund actually has positive performance on a year-to-date basis through yesterday. They're a little over 1%. And that carries forward into really, really strong performance on a long-term basis. You can see their 3-year return is 9.26 versus the benchmark at 4.5 versus the universe at 4.7. 5 years, 8.6 versus 4.7 and 4.4, et cetera. So really strong performance through all periods measured. So even in a down market in 2018, they were down a little less than 10%. The index was down 12. The universe was down over 13%. So because we perhaps are making a fund change on the American Century Emerging Markets Fund, we thought this would be a good time to upgrade the portfolio. As you recall, the Virtus Fund has a little over 1% of the assets, so it's a fund that's not necessarily overexposed. There's very little exposure across the board, but nonetheless, we do think having a dedicated midcap value fund is important to portfolios. So, this particular manager, I think in particular, they're looking at key traits, better business models. They're looking at margins of safety, trading at a discount. They're looking at positive change, like they're as fundamental drivers in particular security. So they've had a really strong run. They do have a valuation kind of screen. So they've got, if you look at their standard deviation is really a risk measure, and they're taking on less risk to achieve the return that they're achieving. So all these things, we just think this will be a significant upgrade to the portfolio. Long tenure manager, 1987. So really, really strong success, and it doesn't hurt that it's going to be 25 basis points less expensive.
It definitely helps, and it's funny how some of these funds, they fall off their objective, and get pretty nice returns in the past 10 years or previous to this year with growth, and they're just falling off the path. So it's good to get to a fund that actually does what they say they're doing. So
I totally agree with that. I mean, it's a more balanced approach too, and it's just, in a high growth market, Virtus will do well. I mean, and thinking about kind of where we will be in 2023, 2024, it's going to be a much more kind of valuation conscious market.
Have any comments, concerns, questions on this fund proposal?
I would just weigh in as being very much in favor of it. We've been kind of waiting to see if we need to move to the brokerage side to replace this.
Yeah.
If you guys want to do it for us, we're happy.
Yeah, there we go. There we go.
That's great. So back to Ellen, should we go back to tab 3 and then proceed chronologically?
It doesn't matter.
Doesn't
You
matter.
could take action on these two items if you want,
Okay.
before going back to the training.
Okay, so that's what we'll do. We'll go through and take action, go back to tab 4. So I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the recommendation of Cap Trust to terminate the American Century Emerging Markets Fund and map the assets and contributions to the American Fund's Euro-Pacific Growth Fund. Any questions or discussions? Can I have a motion?
So moved.
So moved by trustee Riley. Do I have a second?
Second.
Second.
Seconded by trustee Bartholomew. And Ellen, I'll transfer this over for the roll call, please.
Certainly. Trustee Bartholomew,
Yes.
trustee McMahon,
Yes.
trustee Martin,
Yes,
trustee Riley.
Yes.
The motion is carried.
thank you. And move on to tab 5. I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the recommendation of Cap Trust to terminate Virtus Ceradex Mid-Cap Value Equity R6, replacing the fund and mapping the assets and contributions to the Victory Sycamore Established Value R6. Any questions or discussion on this item? Hearing none, can I have a motion?
So moved.
So moved by trustee McMahon. Second,
Second.
seconded by trustee Bartholomew. And Ellen, I'll transfer to you for the roll call, please.
Trustee Bartholomew,
Yes.
trustee McMahon,
Yes.
trustee Martin,
Yes,
trustee Riley.
Yes.
The motion is carried.
thank you. And Barry, we'll go back to
I'm trying to- Yeah, where is this?
tab 3 for the fiduciary training.
Yep. I think it's just a couple pages here back. Here we go. As you all recognize, we sent out kind of a brain shark of fiduciary responsibilities, recognizing that you are a non-ERISA plan. We use ERISA as a guideline. It's the highest standard in the land by which to operate these programs. And so we sent out a brain shark, and we wanted to give an opportunity for any of the committee members or trustees to ask any questions or comments with regards to that fiduciary training. I see one hand.
Could you just list for us who the trustees of this plan are? Sorry, who the fiduciary trustees of this plan are? Because it was a little confusing in the training as to are we fiduciaries, are you a fiduciary, some of the employees of the system fiduciaries. Could you list who the total fiduciaries of the plan are?
Certainly Cap Trust, there's no doubt we are a fiduciary with respect to the plan. We're providing advice for a fee. So we are absolutely a fiduciary with respect to the plan. I think any member that has control over the disposition of assets, i.e. the trustees that we're talking to today, are clearly going to be fiduciaries with respect to the plan. And then the rest is really more delegation of responsibility to these trustees.
So there are no salaried employees of the University of Maine system who are fiduciaries of the plan?
I don't believe so. I mean, Tracy, did you? I don't believe that. I think the answer is no to that question.
I've always felt that I am, just because, honestly, but that's not a bad thing, even if I'm not technically, but I always, I feel I have some decision making that does influence outcomes. And so I always act in the best interest of the plan.
Good point.
Would it be possible to produce a list of the fiduciaries so that we have actual knowledge of this?
Yep. Well, and the other thing to point out is in TIAA, in their capacity, when they provide advice to your participants, they use Morningstar for that advice. So downstream, in essence, Morningstar is also a fiduciary with respect to the advice that they provide to participants. So I do think that would be a good a good idea to list the fiduciaries with respect to this plan or these plans. Yeah. That's a really good comment. Thank you.
Great suggestion, great comment. And I'd encourage if any of you have not already completed the training, it just brings the importance of acting in the best interest as a fiduciary to the forefront. It's a good reminder. I always enjoy these trainings. So I'd encourage you to do so. Take 20 minutes of your time and watch the training.
Kelly, can I ask a somewhat unrelated question, maybe for Tracy? We had a brouhaha a while back with some retirees who were concerned that TIA uses Millennium Trust Company for those, I think, IRAs that part of our. Tracy, are you familiar with this? Is this anything related? Do we need to have this on our radar?
Thank you for the question. And we did look into that at the time, Barry as well, and Tia. We feel comfortable with the approach that we've taken. You did some due diligence around that, Barry. I can't recall all of it off the top of my head, but I certainly was satisfied to make sure we were doing everything prudent. I don't know, maybe you can recall some of those particular details, but I felt very confident.
And just a level set for the trustees' benefit, when a participant joins the University of Maine system and they leave, within their first couple of years, they don't accumulate a lot of balances, anything less than $5,000. That is a drain on the overall system because there's a fixed cost to maintain a record on TIA's platform. And so we did some due diligence. We did a national search for outsourced IRA providers. And we independent of TIAA, recommended Millennium Trust as that provider. We felt really comfortable with that. TIA also recommends Millennium separately and apart from that, but it's really for those balances that are less than $5,000. Right. They tend to move around a lot, and so it creates a burden on the University of Maine system to keep track of those low balances, and so it's another opportunity to kind of offload that to a separate IRA provider.
And the question for Sven and David was whether this was a credible company. They had a lot of consumer complaints, and apparently there was a lack of understanding by the retirees and employees that this was happening. So I think it was a communication issue more than anything. But it is a well-rated company, as I recall.
And I think that, as I recall, they dug something up from like 2012, and it was, obviously the power of Google. There was something that came up, but they addressed that as well.
Okay.
And I would add that there are letters that go to all those affected participants well in advance, giving them options about their choices. They could transfer them out, the money's out, or they could allow them to roll. And I would also say, but regarding the drain on, the cost to the institution, it's really the participants, because the institution doesn't pay these sorts of fees.
Yes,
so back to that fiduciary responsibility, other participants are paying the burden for maintaining very small balances for these participants. And some honestly don't even know they have these monies there. And so dispersing the money, isn't necessarily a bad thing, but and we did communicate, but I heard loud and clear the concerns, and we take that into consideration. And look,
do we know if Feiner and company have been satisfied, or the letters keep coming, or has this, because it also AFM got engaged, so.
Yeah, we've heard nothing since that time.
So we think they're satisfied.
I would have to believe that they are, otherwise I'm sure we would hear.
And I think the thing about that is once they roll it over to Millennium Trust, at any point in time, daily, they could call Millennium Trust and roll it over to some other organization, IRA, et cetera. So it's not a one and done either.
Yep. Good. I just want to make sure that that's on the record and that we're watching it. We've resolved it. Thanks.
Thank you, Barry. And I think that comes to an end of your presentations for this morning. So thank you very much for the great information. And we're 30 minutes ahead of schedule.
Wow,
Yeah. Do I get the award this year?
you do.
Maybe I got to give it to Barry though. He's been
Yeah,
doing all the
yeah. Mike is just verbose, you know, so I get to the point.
We'll pick on Mike. So,
Well,
all right.
Thank you all. Thank you all very much. Have a happy holiday, and we'll see you in the new year.
All right. Same
Thank
to you.
you.
Take care.
And
Barry.
Kelly Martin, Trustee Martin, I did ask Kelly Regan to join early, noticing we were wrapping up early. So I think we're on
Great.
track to do that.
Thank you, Tracy. Morning, Kelly.
Good morning, everyone. It's good to be with you today. Hope you're all well.
Yes. Thank you. So we are moving right along in the meeting. We're on tab 6, and I'm going to give you the floor to discuss the next 3 tabs. The performance review of the management investment pool, pension fund, operating fund, fossil fuel exposure update, and then a final action item on the passive large cap equity manager. So without further ado, Kelly, welcome.
Okay, sounds great. I'm going to share my screen, so just give me a moment here. Let's see. Can you all see this okay? Give me a thumbs up. Awesome. Okay. I know that CapTrust probably spent a little time on markets, but given the market environment, I'm going to continue to spend more time on that if that's okay. I know it's difficult news, but I think it'll put perspective on the portfolio performance and kind of our outlook going forward. So with that, just starting here on page 122, we have the performance for the quarter in this second column here. What you can see and what you've probably already heard is a very difficult third quarter across the board. And when you think back to the quarter, and I know we're a few months outside of the quarter and things have been better, but if we think back to the beginning of the quarter, the stocks started to rally in July. They started to continue to do well because it seemed like the Federal Reserve was going to make progress in bringing down inflation and not have too much harm to the economy. And then the markets continued to rally in August. The Labor Department came out with an unemployment rate that fell down to 3.5%. So the markets like that as well. But then in mid-August, we saw, inflation signals turning higher again. And Fed Chairman Powell came out saying, no one knows if these higher interest rates or the process of us raising interest rates will signal a recession. And that there's still issues in the market environment, such as supply chain disruptions, higher wages, higher prices for food and energy that could continue to keep inflation high. So that obviously spooked the markets. Everything that's been happening in the markets, a lot of it is reliant on what's happening with inflation prints and what the Federal Reserve is saying. And so because of this, we saw Treasury real yields continue to rise in the third quarter, as the Federal Reserve had 2 75 basis point hikes during the quarter. We saw the yield curves flatten. And even today, when we look at it, we have the 2-year Treasury 70 basis points higher than the 10-year. So now it's more in an inversion curve. And this is really one of the largest gaps that we've seen since the 1980s. So this could mean, are we going to have an impending recession? Or is the Fed going to manage their rate increases? Inflation going to come down and the Fed's going to bring down those short-term rates. So there's a lot of uncertainty around inflation and what the Federal Reserve's doing. So as you can see in the third quarter, as a result of this, equities were negative across the board. We had international markets, the MSCI EAFE and the MSCI EM index down more than US equities. And a lot of this is due to the strengthening dollar that we saw. And I have a chart on that in a moment. It's not shown on the page here, but for the first time in a few quarters, we had growth equities do quite well during the quarter. However, on a year-to-date basis, and you'll see this with a couple of your managers, growth equities continue to trail. In terms of fixed income, because of those higher yields, that drives bond prices down. So the broad benchmark for fixed income is the Barclays aggregate. That's that second row here in the credit section. That was down 4.8% during the quarter and down 14.6% year to date through September. And that was at that point in time on track to being one of the worst calendar years for the index's 45-year history. So everything's moving to one in terms of correlations during the quarter. There was really nowhere to hide except the US dollar. If we roll this forward to current markets, October and November have been a lot better. The S&P 500 is up 12.5% in the fourth quarter to date through last Friday. When we look at these year-to-date numbers in this column, for example, the S&P 500 at the time of the third quarter was down 24%. That's only down 14% now. So we're kind of out of that bear market. And then the MSCI EAFE is down about 14% compared to the 27 I'm showing here. And then EM, is still struggling, down 21%, but has come up from this. In terms of fixed income, we have seen rates fall a little bit. So fixed income with the Barclays aggregates down about 12.8%. Earlier this week, we saw, kind of news from some Fed chairmen, specifically in New York, that, rates could continue to go up. We're seeing the protests in China, which has concerns about China's future growth and if there will be any supply chain disruptions. But then yesterday, Fed chairman spoke and he said that it could be time for the Federal Reserve to start moderating rates, indicating potentially that when they meet on December 13th and 14th, we may see 50 basis points instead of 75 basis points. So the market really liked that yesterday, and we had a rally yesterday. So the messaging here is there's a lot of volatility in the market. It's all dependent on what the Fed's doing, what's coming out with the inflation prints. And then we also have things coming out on December 8th with the jobs report, more inflation data coming out when the Fed's meeting around December 13th. So with all this, it's just a lot of volatility. When we look at a 60-40 portfolio, and I thought this was interesting to show the committee because 60-40 portfolio is almost like the starting point for a diversified portfolio. 60% US equities, 40% US bonds, kind of the starting point that endowments and foundations look at, pensions plans look at, and so forth as they're starting to figure out their asset allocation. And we had plotted here, and it's changed since then, but as of 9/30, down 20% for a 60-40 portfolio in 2022. This is one of the worst years on record. Now we're only down about 14%, which equates to about, the early 1970s. So it's still a pretty bad year, even though we've had October and November rebound. When we think about what this means in terms of market loss, this is about a $9 trillion loss that we saw, which surpasses what we saw in 2008, at the time of printing this materials. And when you think about your three portfolios, the managed investment pool is one that's more in line with a 60-40 portfolio in terms of the amount of equities and fixed income. That portfolio is down about 19%. So it's doing better than a 60-40 portfolio, but certainly, still disappointing returns. The pension down 15%, less equities, so faring better. And then the operating fund, more short-term fixed income, very small amount of equities, down about 5%. So I would say all three portfolios are doing better than the 60-40, even the MIP. When we think about kind of this bear market that we were in, we have here plotted in the light blue line 2022. Again, this is through the third quarter. You could, come up a little bit from here from now. It's about down 14%. But what we showed here is other bear markets that we've had in the past, and they all come in different shapes and sizes. We have the 2020 bear market, early COVID pandemic, very sharp decline, and then it quickly rebounded. And we all know the great returns that we saw in 2021. And then we plot the great financial crisis in 2008 and some other market environments. And, there's a lot of, I mentioned there's a lot of uncertainty here. The 2022 is trending somewhat similarly to the early 1970s, certainly not exactly the same, but similar dynamics with the Federal Reserve raising rates and higher inflation. If you look at this dark blue line, you can see, it came down to where we were at the end of the third quarter, and then it popped back up, and then a lot of volatility around that, and then a recession. So that's kind of what we're keeping our eyes on. And when we think, about our portfolios and what we're counseling for our clients is to have a little bit more of a conservative risk posture. We are not recommending a full rebalance back into equities at this point. Being underweight equities slightly is okay. If we saw another shoe to drop, if something material happened and then we saw another decline, I think you would hear from us, maybe it's time to start getting back into risk assets. So those are some of the things that we're looking at in terms of this bear market. I do want to mention inflation a little bit because we have been seeing inflation in terms of full CPI trending down. That's that dark blue line, and you can see it trending down here. However, core CPI, when you take out energy and food, continues to trend up. And that's one of the things that we're watching. And part of the reason that it's trending up is because shelter has a big impact on the core CPI. It's about 40% of that core CPI index. And we think that this can continue to trend up just because rent increases take a good year to kind of flow into this index. It's really a lagged indicator. And when we think about this going forward, even if we saw 0% increase in CPI month over month, it's really going to take into, late 2023 for this top line inflation number to come down. And so when we think about what the Federal Reserve is trying to do, they're trying to get those short-term rates to be in line with inflation. They're not going to stop raising rates, or historically haven't stopped raising rates until the Fed funds kind of match the inflation number. And right now we're at Fed funds at 4% and inflation at 8%. So that's kind of why we're seeing those rate increases. I mentioned kind of where we are today. This is what the market is pricing in for short-term interest rates. We're kind of at this 4% level today. Market's pricing in that we get up almost to 5%. So maybe that's 50 basis points in September and then another 50 basis points early in 2023. And then it kind of stays stable. And I think that's kind of the hope that inflation will start to come down closer to these 5% levels. Overall, the Fed's trying to target, about a 2.5%, 2 to 3% inflation target, and we're not even close to that. I mentioned that the dollar strengthened and that put pressure on international equities, and you saw that on the first page. And, it has since come down a little bit. This is another item that we're watching. As the dollar strengthened, that puts a headwind towards international equities and also a headwind towards U.S. companies that earn revenue overseas. The dollar was the only positive in the third quarter, and it was at its 20-year high, and that's just because of Federal Reserve raising rates quickly. And the reason why we're watching this is if it did continue to strengthen, for those companies that are, generating earnings overseas, they can see an impact. Emerging markets that have a current account deficit, they could start to see an impact, and this could create a risk-off environment, and maybe is some of that downside that I showed you from the bear market chart earlier. So another area that we're watching in terms of the market environment. So what does this mean? Overall, I think the one key issue that we're grappling with is stagflation. And we have those dynamics that exist today. We have very high inflation and we have concerns around future growth, concerns around corporate earnings. We haven't seen much of a material shift with the exception of some of the bigger tech names. But if we move into a recession, then the earnings will come down. Over in Europe, we have concerns that we're seeing around the energy issues with Ukraine and Russia, and really concerns, overall with energy there. And then in China, all the things that we're seeing around their zero COVID policy, the strict lockdowns, and things of that nature. It's the second largest economy, and that can really impact the world. And then the US dollar as well. Those are some of the key things that we're looking at and concerned about in terms of, future growth. So with that, concerned about the markets, underweight posture to equities, The fixed income returns, while they're negative, we're seeing higher fixed income yields. So it's starting to get to a point where credit is more attractive than equities. And, you could hear from us as we review asset allocation next quarter, could it be time to kind of look at our fixed income allocation, especially on the short side of the market? For clients that have a currency hedging program in place, which you do not, we were talking to them about looking at that program as it made a lot of money in the third quarter and maybe taking some of that off the table. And then if we look more towards portfolio positioning views, I mentioned the underweight equity posture. We still have very high conviction in value type strategies, which you do have some in your portfolio, and also active global equity strategies, which you have in your portfolio. And even though fixed income has not been a good place to be, we still are recommending maintaining it and having some portfolio duration in your portfolio. And then what we're starting to look at is short-term investment grade and even monitoring the high yield market. I don't think high yield spreads are quite necessarily, where we would be at a point to say like step into high yield positions. They're above median levels, but they're not really pricing in economic stress yet. So those are some of the areas that we're looking at in terms of portfolio positioning. In terms of your portfolios today, there are no recommendations to make any shifts based on this outlook. So I will stop there and see if there's any questions. Hopefully I didn't reiterate too many items that that Cap Trust went through already.
A lot of things to take into consideration. Good summary of all the complexities that we face right now.
Absolutely. Thank you.
Kelly, are there areas we should be concerned about or focused more attention to as this environment's so dynamic right now? Are there any specific areas in the portfolio?
Well, I would say in terms of asset allocation, we're comfortable with the asset allocation. I would say in terms of managers, and I'll get to that in a moment, there is one manager that I'm watching closely, which is one of your international equity managers, J.O. Hambro. It is on watch because of a acquisition of the parent company. And so it's a kind of a organizational watch structure. On top of that, I'm watching them for performance. They're a core international manager with a growth tilt. They are down significantly year to date. When we talked to J.O. Hambro, they were pricing in a more moderate interest rate hike, and that didn't happen. And so what happened is that they got their valuations wrong because the rates go into their net present value of their growth companies. And so their companies were down more than they had expected. And because of that, they also got their defensive positioning wrong. If we look at their portfolio and kind of where they're going towards going forward, they're pricing in about a 50% probability of a recession. So they're turning their portfolio to be more defensive. Now, that's going to be great if we continue to see the pressure in the market, but if we're seeing what's happening in October and November and they've moved to a more defensive posture, they could be potentially continue to underperform. So that's one of the managers I would say that I'm watching most closely. Other than that, all the other managers are doing what's expected. And there's a lot of bright spots in terms of manager performance in the portfolios.
Thank you.
Yeah.
So that begs a question, Kelly. What's your sense of, do you have a 50-50 sense of recession, potential recession?
So we don't put probabilities on that. For me personally, there's a lot of uncertainty around it. I mean, there's certainly a lot of things that are leading me to feel like, oh, this is not feeling good, and it could get that way. The Federal Reserve could get it right. So I don't know, but there certainly is that risk out there.
Either last meeting or a couple of meetings ago, you talked about private equity. How are private equity valuations fared in this environment?
Sure. So what we're seeing in the third quarter here is it takes about 12 months or so for private equity valuations to follow what the public equity markets are doing. So really, through the second quarter, nothing was being seen, and private equity was still a real benefit to portfolios, as it wasn't down. It was actually positive when the public markets were down. But in the third quarter, depending on the type of private equity you have, if it's mostly venture or buyouts, we're seeing anywhere from a 3 to 10% drop in private equity valuations in portfolios during the most recent quarter. I would say that, for clients that do have a private equity portfolio, it's not something that you can time. And the benefit of private equity is that you invest with a manager that has a 3-year investing horizon and can pick up companies on these dips, right? And so typically after a very bad year or after a recession, private equity actually has their best year. So even though we're kind of seeing some of the pressure, specifically in the venture space, it's still, we believe, is a good time to continue your commitment pace for those clients that have active programs. If there's no other questions, I'll turn into the performance review. Is that okay? Okay. Just starting with the operating fund here, you can see that portfolio assets were just a little over 320 million. The asset allocation is in line with policy ranges. I will say that the total return pool is below targets of 22%, and the liquidity pool is above targets. That goes in with having a little bit more, lower risk posture and not rebalancing too much. And also, these weights do fluctuate based on kind of the spending out of the liquidity pool over time as well. But given future cash needs, we did not recommend rebalancing from the liquidity pool into the total return pool. In terms of performance, the quarter down 1%. This year to date is a calendar year to date. So the quarter would be your fiscal year to date. The year to date column is your calendar year to date. So the first 9 months of the year, you can see it's down a little over 5.5%. When you look at the returns for the composite, which is the operating fund versus the allocation index, you can see that the composite has outperformed the allocation index over all time periods. So that what that means is all the managers in this operating pool in aggregate are outperforming benchmark. Certainly we have ones that are doing better than benchmark and some that may be falling short, but all in aggregate, they're doing better than benchmark, which is great to see. Managers such as Newton, which is your global equity manager, that's very defensive in nature, has been outperforming. Lighthouse, which is a global long short equity manager, has been outperforming, given that their shorts are doing well in this down market. And then some of your fixed income managers, specifically a large manager in this portfolio, IR&M, Income Research and Management, short-term bond manager, has been outperforming. In October, this portfolio was up 50 basis points. And then in November, I'm estimating it's up 1.5%. So that's 2%. So you can take this year-to-date number and say maybe we're down about 3.5% calendar year-to-date. At the last committee meeting, you voted to terminate Vanguard Total World Stock and hire Silchester Exclusion Trust, which is the fossil-free international equity strategy, and the SSGA S&P 500 index strategy, and that was funded in October. And as I noted earlier, there's no recommendations at this time. However, later on, I will bring an item to you that has the potential of moving this SSGA S&P 500 index to the fossil fuel-free version. The operating funds ESG dashboard, we show this every quarter now. I do want to just say that the ESG integration, which is the percentage of your managers, excluding cash, that are rated 1, 2, or 3 by NEPC, this number did increase during this quarter, partly because you terminated Vanguard Total World Stock, which is a 4-rated manager, and hired Silchester and SSGA, which are both 3-rated managers. So that improved the ESG integration. In terms of the pension fund, we have about $20 million in assets. So this fund continues to decline, one, because of market movement, but two, because of the benefit payments that are being paid out every year. The asset allocation is in line with policy targets. And for the quarter, you can see that managers performed right in line with their benchmarks. Over the year-to-date time period, you can see underperformance here. And part of the reason there is Walter Scott, which is your global equity manager, having a little bit more growth tilt to them, similar to J.O. Hambro that I mentioned earlier. But when you look at them ranked in a pool of global equity managers, they're ranking right around median. So yes, they're underperforming, but they're not performing terrible. There's other global equity managers that are faring way worse. Over the longer term, you can see that the returns are quite muted. Part of this is because of the recent year, over the last 10 years, about 4.4%, underperforming the allocation index by 50 basis points. Some of the things there were just historical managers that are dragging down the returns, and then also kind of some of the more recent time period returns of the growth equity manager. October, this plan was up 1.3%. In November, I'm estimating it up being 3.5%. So, let's call that 5%. So year to date, we're down maybe about 10%. And nothing's changed with the ESG dashboard. This has remained the same since the last quarter, as there's been no manager changes. In terms of the managed investment pool, you can see that assets are about $320 million. Similar to the pension, this asset allocation is in line with your policy targets. The managed investment pool had a really good quarter on a relative basis. You can see that we had about 60 basis points of manager value add during the quarter. Small cap managers are doing well, both in the US and emerging markets. And then also managers like Newton and Lighthouse that I mentioned earlier in the operating fund are doing well, protecting some value. When you look at this versus endowment and foundation peers, you rank above median. Part of that could be some of the peers starting to see some of those valuation drops in their private equity. I think when we talk about peer rankings for you versus your endowment foundation peers, the main one difference is not having that allocation to private equity, which has been a benefit in the past, and some of the reasons why the rankings are below median. But as we see those private equity valuations drop, I would expect that your rankings to be a little bit better than median. During the quarter, MSCI EFI by SSGA was terminated, and Silchester was added in this portfolio as well. That's that fossil fuel-free manager. And we already talked about J.O. Hambro. We placed them on watch because of the organizational update. And then, for your portfolio specifically, also keeping a close eye on performance. No big recommendations, except later on we will talk about the potential to move the SSGA S&P 500 index to the fossil fuel-free strategy. With ESG, no material changes here in terms of ESG integration. When we went from SSGA to Silchester, both are 3-rated managers, so there's really no change there. So in terms of performance, and I apologize if this is an eye test if you're looking on your screens. Overall, I'm going to focus on the year-to-date column here and just skip over the index of SSGA because it's in line with its benchmark as expected. But kind of, I mentioned small cap was a bright area. And again, all these comments are relative because nothing's, nice absolute numbers. But both DFA and Westfield are, outperforming their benchmarks. In aggregate, outperforming the broad, small to mid-cap universe, ranking very well versus peers. So this has been a bright spot for your portfolio over all time periods and continues to be. Walter Scott, I mentioned them earlier, down about 3% versus their benchmark, but ranking right about medians, 65s, close to median for the quarter, even though they underperformed. Some of the things that are going on with Walter Scott is, one, they invest in both US equities and international equities, and they're underweight US versus the benchmark. And we know US has performed better than international. They're finding more value in international. Also some of their financial holdings. So they have a Hong Kong financial company that has not benefited from these lockdowns and what's been happening in China. And then also exposure to Prudential in the UK. And there was some things that happened with UK during this quarter with some new policies they have there and some kind of downturn in the fixed income markets. They also have exposure to Nike and Adobe, you know, the PDFs that we all use, which also didn't have a good quarter. We talked about J.O. Hambro already, but just to put numbers to the page, they're down 13% compared to their benchmark, ranking in the very bottom of their peer group universe. It's a relatively new manager. If this was a manager that had a longer track record in your portfolio that looked like this with a watch status, I would probably be bringing you a new option. But if you saw, you know, their longer term track record, you know, over the longer term, it still looks good. So it's just the timing of hiring them has not been beneficial. And then emerging market equities, the combination of the two managers has worked out really well. Having the small cap exposure through Mondrian has been much better than having the large cap exposure through Aberdeen. And part of that is having less China exposure in the small cap. So you can see, you know, the rankings here in this light blue that your EM portfolio ranks very well over most time periods in the top half of other EM managers that you could hire. On this next page, we have fixed income at the top. You know, I mentioned that the Barclays aggregate was down and it's having one of its worst years on record. But your portfolio on a calendar year to date basis is 4% better than the Barclays aggregate. So the diversification in your fixed income portfolio through tips, through short-term credit with BlackRock and some diversifying credit with BlackRock, and also some of the bank loans has been performing better than the Barclays aggregate, providing you some diversification. And when you look at your fixed income returns from a ranking perspective versus the full fixed income universe, you're ranking better than median or even in the top quartile over some time periods. Newton continues to add value on a relative basis, ranking very well versus peers and doing well versus benchmark. And then Lighthouse was positive for the quarter. Again, having that short aspect of their portfolio was beneficial. And you can see their returns are strong over all time periods and ranking very well. For the pension fund, all the managers here are the same that we just went through with the exception of one, and that is Principal down at the bottom. That's a real estate manager. They continue to rank really well. Performance is in line with the benchmark. You know, real estate has had a really good last year, really in the industrial space and multifamily space. This is one of the areas that I want to take a deeper dive in going forward through our asset allocation study. It's kind of, we're at a 10% allocation, 8% is our target. Right now they have a gate up, meaning we've put in a redemption request to get us back down to our target and, you know, are waiting to get that money. But going forward, is 8% the right allocation to have in core real estate, given the market environment? So I'll be looking at that for the asset allocation study, but it has been a benefit so far to the portfolio. Again, one of the positive areas, up, you know, almost 11% year to date. And then the operating fund, I'll just point out some managers here that are not in the other portfolio. Income Research and Management. Again, remember, this is a separate account mandate that you fully divested from fossil fuels from. They outperformed during the quarter, year to date. They rank very well over all time periods versus other short-term managers. And again, this is a short-term credit manager, kind of taking on the theme. This is a good area that we would want our clients to be in at this time. And then PIMCO All Asset, you know, difficult quarter and year to date, but great long-term returns. This is a good diversifier into the portfolio, as it does bring in a little bit diversifying risk exposures through commodities and real estate and emerging market equity and things that this portfolio doesn't have and does it in a good risk management way. Disappointing results more recently, but longer term has been a good manager. So I will stop there and see if there's any questions on portfolio performance, any of the managers that I walked you through, any concerns that you may have.
Kelly, quick question, and I might be a little bit ahead of you. On page 141, though, we have this due diligence monitoring, and we have these three funds. And Lighthouse was brought up several times, but just tell us, give us more narrative around these in terms of what we should be concerned with, what future actions may be warranted. Just kind of give us an overview, if you would.
Sure. So J.O. Hambro is the most recent one. That's why we have yes in this column, just to orient you to this page. PIMCO, it didn't have a recent announcement this quarter, so it has a no. But the announcement was there are some allegations around sexual allegations around some of the members at PIMCO. And so at a firm level, we have a watch status on them. So it's not specific to the product, but it's more of like a concern that we're watching around the organization. I believe they're going through lawsuits, so there's not a lot of information around it. So again, that's why we kind of have had them on watch for some time and haven't taken them off, just because we're waiting to see kind of will anything transpire from that. Similarly with Lighthouse, again, it's not a recent announcement, but I believe this is around just some organizational changes. And I believe it's merging with another hedge fund manager. So again, watching that and making sure that those types of changes aren't detrimental to the strategy, that the portfolio managers stay, the process is staying the same. So again, it's not concerns around performance or team, it's more at the headline firm level. And sometimes, you know, these watch statuses can stay for, you know, a good year. Sometimes there's just a quarter. There's no timing on kind of how long they stay on watch. It's really until we can get comfortable to either remove them or say, okay, well, we're not comfortable with this. We're going to move them to a more, you know, severe status of hold or client review or terminate. So it can go both ways. Okay. If it's okay, I'll move into the fossil fuel exposure update.
Yes, go right ahead. Thanks, Kel.
Okay. Yeah. So given the divestment announcement, I thought it would be a good idea to take a fresh look at the fossil fuel exposure of the portfolios, especially because now, you know, the guideline is to divest from the carbon underground 200 list. And previously, I would go to the manager and say, tell me what your fossil fuel exposure is. This time I went to the managers and said, tell me what your carbon underground 200 exposure is. For some of the managers, they're able to provide it to me. For other managers, they weren't. Part of the reason is because you have to purchase the list, and some organizations have not done that, may not do that, or have not done that yet. So when you look at the exposure, it still is a mix of what the manager says their fossil fuel exposure is, whether it's just the oil, gas, and coal industry. Some managers still have full energy exposure is what we've gathered from them. But a good number of the managers, we have the carbon underground exposure. So it's still a little bit of a mix. It's getting better, but it still is a mix. So I just wanted everyone to be aware of that. So to start with the MIP, we have all of your managers listed here. The type of account, most of them are commingled funds, except for Westfield, which is the direct separate account that you've already divested fossil fuels from the carbon underground 200 list. And the source, so you can see the sources here. We have, 1, 2, 3, 4, 5, 6, 7 managers out of the list, almost half of the list that gave us the carbon underground 200 exposure. Overall, what you can see down the bottom is you have about a 2% exposure to fossil fuels and 6.5 million exposure in dollars. When you compare this to the last time we looked at this, which was about a year ago, a little over a year ago, March 2021, you had 1.9% exposure to fossil fuels and 8.8 million in terms of dollars. So, the percent exposure went up slightly. The dollar exposure came down. The dollar exposure came down, one, because of Maine Maritime leaving the pool. So the assets that decline there, and then also the market decline. In terms of the slight increase, I would note that one here, Newton, we're looking at their energy exposure of 5%. I would think it would be a lot less if we were able to get the direct fossil fuel exposure. So I would say that we're in line to where we were the last time we measured this. We will talk about in the next section, this SSGA S&P 500 index at the very top that, you know, is 0.8% of the 2% exposure. So if the committee was to vote to move this to the fossil fuel free index, our total exposure would go down to 1.2%. So very negligible. So just to put that in perspective and kind of tee up the next topic. For the pension plan, similar story here, you know, in terms of estimated allocation, 1.3%, it was 1.1. Again, Newton is in this portfolio as well. I would expect this energy exposure to be less in fossil fuel terms. And then in terms of dollar amounts, you know, about 250,000 of exposure. So negligible compared to the managed investment pool, which is a much larger pool. And then the operating fund, you know, we did see quite a bit of decline here. One being because IRNM, we don't have any fossil fuel exposure there anymore. And then two, we moved from Vanguard into SSGA and Silchester, and Silchester has no fossil fuel exposure. So we went from a 2% allocation to fossil fuels down to 0.8%. So quite a bit of movement there. And then in terms of dollars, 6.5 million down to 2.5 million. So some progress has been made on the operating fund just in the recent quarters with some of those changes. If you were to select the SSGA S&P 500 fossil fuel free strategy that we'll talk about down here at the bottom, that would bring the 0.8 down to 0.6, because that's equating to, you know, 0.2% of exposure. So again, very negligible in this portfolio as well. Any questions or concerns on the exposure? I think the good news is it hasn't gone up significantly. It's trended down in some cases or stayed relatively stable.
Kelly, thanks, Kelly. I think what we use, I don't remember the resolution well enough, but what we should have is a graph that shows us the three pools where we started from when we divested. I think we said we would be fully divested by 2030. Wasn't that the resolution? Wasn't that the compromise, Kelly, Martin? Anyway, we can check that. And just have a bar graph that we can watch over time. So as an investment committee, we can manage our success in divesting.
Absolutely, Trish.
It'd be just so much simpler. And I think we do need to report back to the board. And I think, and especially where the nuance with the loss of the Maine Maritime money, it gets confusing. But if we just had that graph, I think that would really help us.
Absolutely. And I agree with you, Trish. It'll be much easier to explain going forward. One of the reasons why I wanted to show the tables was to kind of help tee up the next session discussion, which will show you kind of what that decision will do in terms of your exposure. But
I think it'll be a good metric for us to keep ourselves focused on our goal.
Absolutely. Okay.
I think it would be good as well to footnote the Newton. You know, you mentioned that it's total energy exposure. Then it says commingled energy exposure, which doesn't necessarily tell the story to a casual observer. And we know people are looking at this. So maybe a footnote that says unable to determine exact CU200. This is exposure to the total energy market, which may include renewables.
Absolutely, David. That's a great suggestion.
Because I'm assuming there is some renewable energy in there.
They are. Remember when they came in, they were talking about one of the companies that's kind of making the transition, and so that would be included in it, but wouldn't necessarily be
I mean, we shooting ourselves in the foot when we go including renewable energy with the Carbon Underground 200.
Absolutely. Great suggestions. I appreciate that feedback. Okay. If it's okay, I'll move on to the S&P 500 item.
Let's go right ahead, Gal.
Okay, so just to kind of give some background, you invest with SSGA in their S&P 500 passive index strategy. You have 72 million in the managed investment pool and 15 million that was just funded on October 1st. You know, as I was reaching out to SSGA to get their exposure to fossil fuels, they said, hey, we haven't looked at fees in a while. We'd like to give you a fee reduction. I'm like, great. So if you stay in the normal S&P 500 index product, we have the current fees here and the proposed fees here. So essentially, they have a tiered fee structure that starts at 5 basis points. You would move down to a tiered structure that starts at 3 basis points. So we're talking about 2 basis points. Index funds are cheap to begin with anyway. And that would be about, call it a $15,000 saving on the MIP annually and another $10,000 saving on the operating fund. So that's real money over time. So at a minimum, Tracy and I will work towards that to get the new fee structure in place. However, at the same time, they provided me information on their fossil fuel-free index strategy. I was aware that SSGA had a fossil fuel-free index strategy in an ETF vehicle, which was 20 basis points. And we've talked about that in the past, how it's very expensive to go into the fossil fuel-free strategy. But they have a fossil fuel-free strategy that's commingled fund, similar to what you currently have, and they will provide it to you at the same fees that they'll provide the S&P 500 index strategy that you're in. This commingled fund is newer. It's only been around for a couple of years. It started in October 2020. And as we talked about in past meetings, the market's evolving to these ESG strategies, fossil fuel-free strategies, and different types of strategies. So the AUM is low, 200 million. Typically we like to see about 300 million, but we're pretty close with 200 million. So it's got a decent amount of assets, but certainly not the size of kind of the strategies that you're in today, which are multi-million. In terms of performance, because they have a short track record, I show third quarter, calendar year to date, and the trailing 1 year, and then also their full calendar 2021 year. To note that their strategy is designed to track the fossil fuel-free index, and you can see that the product is doing that if you compare the first row to the second row. I also put the S&P 500 index here because that's what you're moving from if you decide to go this approach. And just show, as we know, energy has been one of the best performing sectors more recently. So you can see that kind of the fossil fuel-free strategy versus the S&P 500 is falling short over the quarter, year to date, and 1 year time period. Over 2021, it's more in line. And so just to note to the committee that, there is going to be more tracking error in this strategy from the S&P 500 index. And that could be positive or negative tracking error, right? Depending on really what the energy sector is doing. To put this into perspective, if the fossil fuel-free index strategy is underperforming as it did over the trailing 1 year of 130 basis points, for the MIP portfolio, let's just say you were in it for the last year, that would have been an additional $1 million decline in assets. So just putting kind of dollars and numbers into perspective for the committee as you think about this, there can be times where, you don't make money on this compared to the broad market just because of the energy sector. In terms of looking at the fossil fuel-free strategy and kind of where you are today, my biggest thing is I just don't want to pay more for this unless the performance show that you're paying more for something. So with this, I'm comfortable that both products, the regular 500 index and the fossil fuel-free 500 index, are the same cost. I think it's just the understanding that if you were to go down this path, yes, your fossil fuel exposure would decline, but there will be periods of positive and negative tracking error, just to consider.
Tracking error, can you just explain the term of art?
Sure, it's just the deviation from the benchmark.
Okay.
Yeah.
But I mean, but given that your first slide that showed some of our managers can't really give us the information we want, and we know we need to move away over time, I guess the question is just one of timing.
Yeah, and for us, we can't help you time. Is it a good time to be out of energy or a good time to be in energy? I think, for the committee, I'm bringing this to you because you did approve the fossil fuel divestment approach. And, I said that as soon as products come available, that could be a fit for the portfolio, that I'll bring them to you to consider.
And we may be a bit off in this, but it's still only 2% of our total portfolio, approximately, right?
Well, for the managed investment pool, it's a much larger, it's 22% of your total managed investment pool portfolio.
Really? Did we
Yeah.
know that?
So I'll go back to the page here. So the S&P 500 index
Yeah.
has about a 23% allocation in the portfolio, because large cap and the allocation to large cap is, the target of 22%, and we've decided to passively manage large cap.
Okay, I'm confused. I'm still trying to I still need the visual, I guess. I'm still trying to figure out where we started from. And as I recall, in our decision to turn all our investments toward over time divestment, I thought we only had a very small portion in energy.
You have a very small portion of energy. That's at 2% on this page. I was just saying that your allocation to the manager in totality
Got
is
it.
22%.
Yeah. Yep. Sorry. Yep. So this would increase our reliance on one manager.
So the fossil fuel exposure would go down, 0.8%, so it'd be 1.2%. But if this manager, the fossil fuel free fossil fuel free strategy underperformed the S&P 500 at such a large weight of the portfolio, that could have a negative impact in terms of asset declines.
Yeah.
And then from what you've shown us in their historicals, Kelly, they've underperformed, what, 1% or less year to date? 23.9 versus 25.1, approximately.
Right.
Yeah. So
But-
sounds like.
But all of 2021, it was only 0.3%.
That's correct. That's correct. So it will fluctuate. It's all, again, dependent on the energy market. And certainly 2022 was, different from the energy market than it was in 21.
And there certainly has been a real uptick in fossil fuel alternative energy as a result of the crisis in Ukraine. So it seems like it may be worth the risk at this point. And as Sven points out, it's not a big one.
Kelly, you mentioned that it sounds like the only minor misgiving you have is on the size of that particular strategy at SSGA. And is the size kind of more directly correlated with their ability to keep expenses low? Because it sounds like they're doing that, or are there other reasons why we need to be concerned about the size?
Oh, the 202 assets under management.
Correct.
Yeah, I mean, I would say that, there's just, if other investors leave the portfolio, you could be left being the only one, and covering all the costs and things of that nature. But SSGA is a very large firm supporting all of these strategies, so there is a little bit less concern because of that.
I guess part of the point is, if they're committing to do it at the same fee level as that, are there any other like underlying costs that we need to be concerned about if we're the only holders of that particular strategy?
I'm not sure if you're the only holders that the fees would go up, but there's no additional cost on what they've already quoted. That's an all-in cost, so that takes into account the custodian costs and everything for the strategy.
Perfect, thanks.
But
Kelly,
go ahead, Sven.
sorry, Chair Riley. One other quick question. If the total fund has over, $200 million approximately, we're going to put 16.5 million into this. We're going to have a fairly large stake in this fund, and that's because it's new, right? Is it anticipated to grow? Do we have any line of sight on that? And then question one, and then question two, do we have other situations where we'd have kind of a larger stake in a fund of this magnitude?
So I can ask SSGA what they have in their pipeline for new business or current clients that are considering this strategy and come back to you on that. In the answer to your second question, no, I don't believe so. All the other managers and funds that you were in are very sizable in nature. You would be a much smaller piece of the pie.
In a former life, I was a fairly hard-boiled businessman, and my question would be, have we asked SSGA to rebate some fees from prior period of time if they're now agreeing to drop them? Have we asked for a rebate for the past year?
I haven't. I can ask when they expect to make these fees effective. Meaning, will it be effective, today or effective at the beginning of the year, or what point in time did this fee schedule drop for others and not for the University of Maine system?
I think my negotiation tactic would be, I'm assuming these were effective January 1, 2022, and see what the response is to that. Because I think anything we can do to mitigate cost, we should be doing.
Yeah.
Yep.
And is it a fee structure change, or is it the fact that we invested more in it and we're eligible for a lower fee?
I do not know. I do not know the answer to that.
So if it's the latter, then David's point's well taken, because we did that a while back.
The new funds just came on October 1st.
Okay.
Right, but the existing fund we're in, they're proposing a drop of $25,000 a year. So my question is, can we get that 25,000 retroactive to January 1, 22 or 21 for that matter?
I will follow up with them on that. However, switching to the new product, I am not sure that they would negotiate that, but we can certainly ask.
Well, let's negotiate that first and switch to the new product second.
Yeah. Yeah.
Where does that put us with our action item? We hold off and wait till you get back to us on that, or?
Or would it help the negotiation for a retroactive rebate if they knew we were buying into an additional product?
Once we've done it, there's no incentive. I'm just wondering where we stand. What kind of bargaining we have.
We can hold off on voting on this until the February or March meeting. I'm not sure exactly what the date is for the next quarter meeting, but it's either February or March, and vote on it at that time, and work on the traditional S&P 500 fund for these next couple months. Or we can vote on it now, and I can work with SSGA on a solution, hopefully.
Or another option would be to move 50% or some other percentage. I mean, there's no law that says we have to move 100%, because again, we're timing the market to an extent. If we make 100% move, and maybe we should make 50% move, or we make 33% a month for 3 months, or whatever you would normally do when you're transferring a large balance.
Yep, we can dollar cost into the new strategy. That's a great suggestion, David.
That way we don't get hung if the index goes haywire on us.
I think that's a great idea.
Jim Bradley has noted that he has to jump off at 11. I'd like to have your thoughts on that before you get off. Jim, if you don't mind, if you have anything to share.
My tendency is toward, it sounds like we're heading in the divestiture direction. And this is my only kind of parenthetical thought that I've always had in my head is that boy, that's going to really kind of jack up fees in order to do that, and to see an opportunity where we don't have that as a concern. I would be A, jumping all over that, B, trying to find a way to horn my clients into the same opportunity as we have here. So, I'm pretty enthusiastic about any decision that the committee makes to move forward with that kind of a move and sooner than later.
Thank you. And any thoughts on what Trustee McMahon just said? To get into it, dollar cost averaging slower, negotiate.
I mean, it's always tough when you're looking at dollar cost averaging issues, whether or not we'd want to, I think, and this is, just a kind of a position on my side that, a good part of divestiture is the fact that the general trajectory of that sector has got some pressure on it to the downside, and so if there's pressure to the downside, dollar cost averaging may not have all as much glitter as it would. However, from a fiduciary standpoint, sometimes that does remove the timing issue from it a little bit, and if there's an easy way of doing it, maybe over the course of a 12-month period, it would be a good way to do it.
Thank you, and thanks for your expertise, and happy holidays. I know you've got to jump off, so
thank you again. I
wanted to
appreciate
get that
it.
in real quick.
Thank you, Jim.
Thanks, guys.
Thank you.
Thank you, Trustee McMahon, for your suggestions. I just wanted to just jump on real quick before Jim had to get off. So, any other comments in regards to this action item?
Chair Martin.
Yes, go ahead, Chair.
Maybe a thought, and that is, but we would be maybe coming into this as a layered approach, stepping into it may not be a bad idea, only because it will give us time to see that portfolio grow, the SSGA portfolio, to see if there's more participants in this plan other than what they have now. Can they get this to 400 million, 500 million over the next few quarters? And it just makes a smaller piece of a larger pie, I guess would be my only thought.
Yeah, I think that's reasonable. Gives us, we go in slowly and watch it.
Procedurally, do we read the text of the proposed resolution and then ask for amendments, Ellen?
Yes, that's correct.
Okay, and then so I'll read the text of the proposed resolution, and then we can discuss how we want to proceed from there. That the Board of Trustees, acting through the Investment Committee, approves the following investment manager changes: terminate SSGA S&P 500 index and replace it with the SSGA S&P 500 fossil fuel reserves free strategy for roughly 23% of the total MIP portfolio assets. And part two, terminate SSGA S&P 500 index and replace it with the SSGA S&P 500 fossil fuel reserves free strategy for roughly 5% of the operating fund portfolio assets. So that was a mouthful. So now we're into discussion on if we want to how we want to proceed. That's the text of the proposed resolution, and if there's any amendments or any suggested amendments, now's the time to discuss.
can I make a suggestion for the committee?
Go right ahead.
I would suggest changing the resolution or making the amendment to the resolution of just don't say anything about terminating the SSGA S&P 500 index fund at this point in time, and just having the resolution or the amendment, sorry, to hire the SSGA, and I'm going to get the exact name here. Fossil fuel reserves free index strategy. And I think the next thing that we need to discuss would be for what allocation and over what time period. So is the goal to get to the target of 23% allocation in the MIP over a 12-month time period? Is the goal to get to half of the allocation or 11.5% over a 6-month time period? What is the committee's thoughts on kind of how much of the allocation we want to be at with this strategy to start over what time period? I think the initial recommendation was to move fully into it. And I think, you know, we talked about more dollar cost averaging to start.
Don't we say the goal is to move it all, but we want to be able to have touch points to look at performance before we make the decision? That we need some language about increment, right? Isn't that what we say? We want to incrementally invest and watch and make the decision over time as the portfolio grows in the fund.
Yep.
So as the over the portfolio's performance and fund growth.
Yeah.
Yep.
Also something said to where the opportune time, I mean, as the opportunity arises, that it would be beneficial, but the problem with that is, you know, that's timing, and we don't have a crystal ball, so.
Well, but couldn't we put in the resolution that we want to go full bore and we'll look at each meeting to make a decision about how we want to move the allocation? How quickly we want to speed you know, we may want to wait.
I think it's dangerous for the investment committee to be trying to decide timing. You know, we hire professional advisors to do that. My caution and my reason for raising it was, you know, and I read it a little differently from Sven. I read it as $87 million that we're talking about transferring, 72 and 15. So it's $87 million, which is a lot of money to move to change funds on an immediate basis. And just for clarification, this is the MIP and the operating fund, so we are not acting as fiduciaries when we make this decision. Is that true? Is that correct?
No, I believe
you're pension fund. This is
not the pension fund. This is not the pension fund.
Not ERISA based, right?
Yeah.
But I think generally we do act in the spirit of ERISA. So yeah, sometimes we need to take greater care on.
Why is the pension fund not included in this?
Because you don't have exposure to an S&P 500 index. Could the resolution say hire the strategy for a 23% allocation in the MIP that will be invested towards target over a 6-month period, over a 12-month period?
You know, on the advice of Kelly Reagan Law, what would you want to use?
Consultant.
So it's clear the timing is your decision rather than a committee decision.
But the goal is clear that we want to do it.
The goal's clear, but we're not going to make it. We're not going to move everything tomorrow and then suddenly find the index goes the other way. We're going to do it over a period of time.
And get yep.
I think we should agree on a period of time, though. I could do it monthly for the next 6 months once the account's set up. Recommend that to Tracy to implement.
What is your recommendation? 6 months, 12 months, given the landscape, what we're looking at?
I would recommend to do it once a quarter for the next year.
Okay.
Once a quarter for the next year.
Yeah.
So this account would probably be set up, if at best, January 1st, we could be looking, mid-January. So once a quarter for the next year with the goal of full implementation by the end of 2023.
Which also gives you room if it's booming, or it gives you room to come back to us if it's a bad decision.
Absolutely. And I would then include it in that resolution amendment, Kelly, to still
Mhm.
terminate the S&P 500 index fund, because that is the goal, to eventually terminate that through the process of hiring the new strategy.
I just also asked from a risk perspective, should the assets in that strategy decline for any reason, that we revisit the conversation? Because we
Absolutely.
would have a significant percentage, and I heard you say that you typically, your policy generally is the 300 million mark, and this is 200 million, so we're already below your mark, and we're a significant percentage when we're fully invested. So I think those are risks that we don't generally take on.
What we can do is on a quarterly basis, track the assets under management.
I mean, I think, Tracy, that's exactly the point of this incremental approach, to see if they grow and take a little risk here.
Right. So I don't necessarily want to do it as an automatic over time, absent that consideration.
So Tracy, I've got a question with that. Are you suggesting that we actually take a look at this based on the recommendation of Kelly at every investment committee meeting quarterly, or?
I'm just saying that I believe that we should be mindful of the amount held in that strategy. And if anything comes to, concern, Kelly can monitor that. I mean, if there's anything that arises of concern, that we revisit the conversation. I mean, we could do that anyway at any time, but I think that's the other consideration we're talking about today, is the assets under management, not just dollar cost averaging in.
Okay, so logistically, if she could reach out to you and I, and then if we need to have an emergency or some kind of meeting to discuss that would take the committee, and we could do that. Is that what you're suggesting?
Yeah, I would suggest, sorry, I don't mean to interrupt. I would suggest that, once a quarter we rebalance into the strategy. I will monitor the assets under management and notify the committee at every meeting. If there is concern at that meeting about the strategy's assets, we can make a motion to stop the rebalancing into the SSGA fossil fuel free strategy, terminate the strategy, or any decision at that point in time. If there's...
Yeah,
Perfect. Thank you.
and I do think reports at our regular meeting will be great. Just to watch it. It's a new venture for us.
Yep.
Okay. So if I'm hearing correctly, and again, just clarification on Robert's rules, do we have to do we have to vote against the motion on the floor, or we can just make it file for an amendment?
Can we do a friendly amendment?
We can do an amendment.
So if I'm hearing this correctly, file for an amendment to hire the SSGA S&P 500 fossil fuel reserves free strategy for roughly 20% of the total MIP portfolio assets, and hire the S&P 500 index, hire the SSGA S&P 500 fossil fuel reserves free strategy for roughly 5% of the total operating portfolio assets, to be done over a 12-month period on a quarterly basis, with the stipulation that if there's any reason for us to revisit the strategy or terminate the strategy, NEPC will reach out to us and give us such notification. That's kind of rough there, I'm sorry. But is that the gist?
Kelly, I would make the suggestion to keep the proposed language of the resolution. I think everything can stay the same. And at the end, you could say to be done over a 12-month period on a quarterly basis. And the strategy will be monitored on a quarterly basis, something along those lines, just to simplify it a little bit.
That's good.
Let's replace done with executed.
Yeah.
Better word, David, better word.
I was educated in England.
I was going with implement, but I like execute.
Tough words this morning.
It's me
Okay.
talking to my 6-year-old and 9-year-old child all the time. You gotta use
Just
a
so I
very,
have
very,
proper language. We're adding over a 12-month period. Reviewing on a quarterly basis and strategy.
Will be monitored. I think the executed goes right at this, to be executed over a 12-month period.
Okay.
Wait,
Okay. So we're leaving the MIP at the 23% allocation, or just say 23%?
23% is the target for the S&P 500 index today. So that should be the new target for the fossil fuel free.
Okay.
You guys are ready for the retreat. At this rate, we'll be crafting the vision statement as a group.
And at this rate of progress, we'll be there for a week.
That's why we decided we wouldn't write it together.
So, to reread what we have, do I need to go over the text of the proposed resolution with that caveat at the end?
Sure.
Okay. So, text of the proposed resolution or amended resolution is to terminate SSGA and the S&P 500 index and replace it with and hire the SSGA S&P 500 fossil fuel reserves free strategy for roughly 20% of the total MIP portfolio assets.
Isn't it 23%? Sorry, Kelly.
Yeah, 23%, sorry. And should I put that caveat for each one?
Yes.
To be executed over
for
or
12-month period.
12-month period, executed quarterly, and the strategy will be monitored. I got that right?
Yep.
And the same true for terminate the SSGA S&P 500 index over a 12-month period to be executed quarterly. Strategy will be monitored. Hire the SSGA S&P 500 fossil fuel reserves free strategy for roughly 5% of the operating fund portfolio assets. Kind of move the words around there, but we just make them equal. Does that sound okay?
I think you need to add that to be executed over a 12-month time period
Okay,
at the end of the operating fund.
Be executed over a 12-month period. How did you phrase
On a quarterly basis.
implemented over a quarterly basis?
Yeah. To be executed over a 12-month period on a quarterly basis. And strategy will be monitored. Is
Yes,
that
and
what
do
we
we,
agreed to?
yeah, and do we need to put in there, or is it implied that we can stop the process at any time if it is recommended by the consultant? So it's monitored. Does that mean that the strategy can be stopped? Because I think that
But
was the
about-
reason.
Strategy will be reviewed by the investment committee quarterly. Because in a review, we'd make the decision whether it's,
Yeah, just like any other strategy, Kelly. I mean, when you hired, J.O. Hambro, you didn't say that it could be terminated at any time,
Yeah.
but you can, right? Based on recommendations that come to you.
So basically, the strategy is monitored says enough, right?
Yeah.
If there's an issue, then we can step sideways. Okay.
because
I would feel more comfortable if somehow we could get the words determined by NEPC in there for the timing. So it's very clear that this is an NEPC guidance decision,
And not ours.
not ours.
Mhm.
That we're not saying as an investment committee, we know everything and this is we want to do it quarterly. So I think we need to say timing to be determined by NEPC.
Point well taken.
or NEPC reports to the committee quarterly. It may be that there's nothing to say each quarter, but I don't know, whatever.
Well, no, but for the execution I'm talking about.
Oh, yeah.
So, I mean, there are 90 days in a quarter.
Yep.
And NEPC has to make a decision to pull the plug.
So I would just want to be clear that we don't move the money on your behalf. We would be providing the recommendation to Tracy to implement.
Right.
And that typically I would make these changes when there are other rebalancing changes that have to be made. It's not necessarily, because I'm not going to have a call on energy versus non-energy. So it's not going to be based on that. It's going to be more based on a timing, liquidity during the quarter.
Could I share my screen on a possible language just to help maybe? Okay.
Yes, please.
Am I showing the right one? It's purple.
Yep.
Yeah, it's purple.
Okay. Okay.
There you go.
Is that large enough?
Yep.
Yes.
And so we already are familiar with this portion, but so to be executed on a quarterly basis or as otherwise advised by NEPC over the coming year with a strategy to be reviewed by the investment committee at each meeting.
I think this is good. And I kind of like the removal of anything that suggests timing on either our part or the consultant's part. And basically the strategy is either a good one or not a good one, but timing is a slippery slope. But I like the way that this reads.
Yep.
So I think what I'm going to do, if this is what we should be doing, Ellen, is just read this so it's a little bit more clear and concise, and we can move from that point.
That's fine.
Okay. So I'd like to propose an amendment to the proposed resolution to read as follows: to terminate SSGA S&P 500 index and replace with SSGA 500 SSGA S&P 500 fossil fuel reserves free strategy for roughly 20% of the total MIP portfolio assets. Terminate SSGA S&P 500 index and replace it with SSGA S&P fossil fuel reserves free strategy for roughly 5% total operating funds portfolio assets, to be executed on a quarterly basis or as otherwise advised by NEPC over the coming year, with a strategy to be reviewed by the investment committee at each meeting.
So with the clarification, that's 23% of total MIP funds. I would move the resolution.
Okay.
And with thanks to Tracy.
Yes, thank you, Tracy. So moved by Chair Riley. Do I have a second?
Can I just ask a clarification? And it's out of ignorance. Does the coming year imply a 12-month period? in the American language, because it doesn't where I was educated. The coming year could be we do it in the first quarter
Yeah. we
because
probably
we're
should
doing
clarify
it in
that.
the coming year. So we really said 12 months, and I would feel more comfortable with 12 months. But if it's absolutely clear to you guys that we're doing it over the whole year, I'm okay with it.
I think 12 months makes sense,
Yeah,
clarify.
I think we need to
Very
be
good.
specific. Point well taken.
Yeah, and I just, because the quarterly basis also sometimes tends to mean to me like on the first of the month, and like, if it's like mid-December is the first opportunity, and then maybe February. So it's kind of not as precise as that language might imply, just because there's various reasons we would, but I would follow whatever NEPC is recommending, but just to be clear on that expectation as well.
So with the amendment of 12 months instead of coming year, I accept the friendly amendment as a mover.
Okay, and that's 12 months effective the date of this meeting.
And I'll second the motion.
Seconded by Trustee McMahon. And Ellen, I'll pass the meeting to you for the roll call.
Trustee Bartholomew,
Yes.
trustee McMahon,
Yes.
trustee Martin,
Yes.
trustee Riley.
Yes.
The motion is carried.
Excellent. And I believe that concludes our meeting.
Nice job.
Yeah, so
Can you just
wanna thank-
repeat that language to me?
Tracy, thank you so much, Kelly, for your guidance, and thanks to all for a real engaging discussion this morning. And I look forward to seeing some of you this weekend. So happy holidays.
See you Sunday.
And
Happy holidays,
if you guys
everyone.
get any snow, send it up.